thinking about moving your property into a limited company? It can save tax, but it can also create huge tax bills if done wrong. Here's what you need to know before you make the move. Often landlords consider this for lower corporation tax rates, easier profit reinvestment, passing properties to family in a structured way, but the tax savings aren't guaranteed. Now here are the big tax traps. Transferring to a company is often treated as a sale at market value. This means you could pay capital gains tax on the gain since you bought it, stamp duty, land tax, including the 3% surcharge. And if there's a mortgage, it's treated as if the company is buying with debt. SDLT still applies. Now, when this might work, it can make sense if you run a genuine property business, i.e. multiple properties, active management. Also, long-term profits will be reinvested rather than drawn out. Now, some partnerships can transfer without CGT or SDLT, but strict rules apply. Other considerations: mortgage deals. Not all lenders offer buy-to-let mortgages to companies. Running costs, annual accounts, corporation tax returns, stricter admin, and future exits. Selling shares versus selling property can change the tax bill. So what's the future tax impact? One thing many landlords overlook is how the transfer affects future tax when you sell the property later. In a company, any profit on the eventual sale is subject to corporation tax, currently at 19% or 25% depending on profits. If you then take that profit out of the company, you could face further personal tax on dividends. So while you might save income tax on rental profits now, you could end up paying more when you exit. So, what steps to take? 1. Get a full tax review. Numbers on paper before you act. 2. Check lender options early. And 3. Consider both the short-term costs and the long-term savings. Moving property into a limited company isn't a simple tax dodge. It's a big restructure. Done right, it can save money. Done wrong, it can cost thousands. If you are thinking about it, read my full guide on our website or book a tax planning call. I get asked this a lot. Can I just give the property to my company to avoid the taxes? The short answer is no. HMRC still treats it as a market value sale. Another common question: will my lender allow it? Many won't, so check early. If you've got a question I haven't covered, drop it in the comments. I read everyone. I'm Dora from Grace Certified Accountants. Please remember to like, share, and subscribe to our channel for more tax tips and advice. Thank you so much for watching. I'll see you again soon.